All right, Diego, can you hear me?
Hey, Josh.
Diego?
Yep, I can hear you. Can you hear me?
Perfect. Yes, I can. We have one attendee. Rob, can you hear us? I'm going to unmute you. Oh, I think it's not letting me unmute him. Okay. I want to broadcast this live to Facebook before we actually start. So give me 1 second.
Give me a second while we get started.
Okay.
I'm not sure.
Oh, is that Rob?
That's him.
Here we go.
Yes, I'm not. Yeah, or what's called first time home buyers. It's going to be a first time home buyer. You'll have special deals. So. Okay. So good.
Are you okay to do in your phone?
We're doing a few different places.
The TV on?
Yep.
What?
What time are we starting this?
Oh, we're starting now. We're live now. I just want to make sure it's streaming on Facebook. All right, guys. So it's Josh DeBrossard, the Firefighting Realtor, here with my good friend and colleague, Diego Rodriguez. He is my preferred CPA, takes care of all my things, all my finances. Trust him with my life, not only my finances. Diego, please introduce yourself to the people.
Hello, my name is Diego Rodriguez, CPA with Realtor Financial Group, and I'm here to talk to you guys today about the benefits of corporations. So I've been a CPA since 2010. I have about 18 years of experience, and I'm looking forward to sharing all that knowledge with you.
Awesome, awesome. So as we're going through this, guys, feel free to put anything under the comment section or the Q&A section, ask your questions. And also, Rob, I did, see if you're still muted. I'm going to mute you, but if you have any questions, please just raise your hand and we'll put you on mute. All right, so you know what? Let's do it this way. There we go. Yes, we'll keep you muted, and then you can unmute yourself if you have something to say, or if you have a question to ask. We are going to be, again, streaming this Facebook Live. It will be posted so that everybody can review it and go through it at their own convenience or leisure. But I love for you guys to participate now so that you get the most out of it, because a lot of the times people don't think to ask certain questions because they don't know what they don't know, you know? So it's good to have you now participating and asking the questions so that this way we touch every cue point. So this is something that we try to do for you guys. It's going to be about 30 minutes, 40 minutes, give or take, depending on the conversation. But we try to make use of everyone's time, make it more effective. So Diego, please, I'll let you take the lead.
All right. So the first thing that I want to walk you through is what's the legal entities that you can do, right? Or you can choose from. So if you start a business and you want to be a DBA, don't want to go through any formalities or anything like that, just go with the local city hall in town to register your business, you can be a sole proprietor, right? You use your social security number, or you can apply for a tax ID number if you don't want to give that number up, and you can pretty much go from there. That's basically your typical real estate agent. You know, you get licensed, you go work for a brokerage, fill out a W-9 with your social, and you're selling houses. If you and another person want to get together and form a business, you can do it through a partnership, right? So you have to have a partnership, you need to have 2 or more people, and you can do business together, right? It has its pros and cons from a legal perspective, but we're going to focus mainly on the taxes today.
Right.
From there, we have corporations, right? So you can be a C corporation, like your Pepsi's, Coca-Cola, McDonald's of the world. And then you can have your S corporation, which is going to be your smaller corporations. And that's going to be typical middle-class businesses is kind of what falls into that category. And we'll talk a little bit more about why you would use an S corp versus a C later on. And lastly, you have the limited liability company. So the limited liability company, it's interesting because it's a form of business, but it's very versatile. So a LLC can be a single person disregarded, and it operates like a sole proprietor. But if you have 2 owners, you can be a partnership unless you make an election to be treated as an S or C corporation. So it's very versatile. You can start with one thing and end up being something else as your business grows and evolves.
If I could interject real quick, guys, I know the last 2 webinars we did were on corporations, and it may seem like we're beating a dead horse on this, but as you can tell, different professions and different professionals in the industry bring their own key points to it. And most of the time, if you're hearing something repetitive, it's because it's important and it helps stick. So don't look at it as much as redundancy. Look at it as an opportunity to learn and make sure the information is sticking. All right?
Exactly. And one of the first questions that I usually ask someone is, well, what kind of business do you want to start, right? There's some businesses that legally have to be a certain type of entity. So for example, if you want to open up an insurance company or a bank, you can't do it as a partnership or a sole proprietor. They usually require you to be like a corporation. So depending on what you're going to operate as, first of all, you got to see if legally you can operate in that manner or not. And then the next thing that you want to look into is how do you plan on raising capital and what type of owners you're going to have, right? The reason why this is important is because if you want to issue stock, well, a sole proprietor and a partnership don't have stock to issue. So if you don't want to have, if you bring somebody into a partnership, they're half owners, they're not shareholders. They're basically running the business with you. Whereas if you have like a C corp or S corp, you have passive investors who are basically giving you money, and they're expecting, a return through either dividends or appreciation of stock. So if you think you're gonna open up, like a technology company, you're gonna develop an app or something, and you want to look for investors from many different places, you're gonna want to be careful with the entity that you choose, and mainly because an S corp, even though it's beneficial, has restrictions. For example, you cannot have more than 100 shareholders. You cannot have foreign investors. So if you have a rich relative, that lives in South America or in Europe or Asia, who wants to give you $200,000, excuse me, to start up for a stake in the company, that automatically takes S corporation off the table. So it's important to think about how you're going to capitalize the business. Are you going to go out and take a loan? Are you going to use your own money? Are you going to take outside money? And that's going to determine what type of entity you're going to fall into. And along those lines also, we touched a little bit about the type of owners that you can have, but we also want to talk about the kind of assets that you want to own in those entities as well. So I'll give you an example, right? Let's say you own a rental property, right? 2 or 3 unit property, and you want to put it in an LLC for liability purposes, right? You say if someone falls down stairs or something, you don't want to be held personally liable. So you put it into the LLC. If you accidentally choose to make that LLC an S corporation, that's a lot different than an LLC as a disregarded entity. And here's why. If you have an LLC, excuse me, disregarded, you can basically move, sorry, give me a minute.
No, take your time. Guys, so honestly, I think we said this before too, is as a realtor or as a business owner, I have an S Corp, and that is what shields me from certain tax advantages that we'll discuss later on. And when I do my investment properties and my flipping, I have an LLC. So since we are specifically geared towards financial literacy and also financial independency, and more towards having those investments and also investing into real estate, we are going to be using a lot of examples of real estate investors, contractors, realtors, flippers, all that good stuff. So
exactly. So I apologize for the interruption.
No,
so basically, right, let's say you have a multi-unit property, you put in a disregarded LLC, right? Now, once the property is an LLC, that it's difficult for you to get traditional lending, right? Residential lending as an individual would get.
mm-hmm.
So a lot of times what people would do is like quick claim deed the property back to their name, get, a residential mortgage on it, and then quick claim it back into the LLC. And there's no tax consequences of doing that, The only main difference is if you were not to do that, you would probably have to do a commercial loan with 20 to 25% down. So once you go ahead and you do that route, you're fine. Let's say now you do the same thing with an S corporation. When you quick claim deed the property into the S corporation, there's no issue there, right? It's basically the corporation's taking over the asset and the debt that goes with it. Now, when you want to quick claim it back into your name, that creates a tax, because you're distributing property from a corporation. So in essence, right, whatever that property appreciated while it was in the corporation, at that day and time, even though you didn't sell it, you owe a tax on it. And that's where a lot of people get hung up, and they don't understand that when you put property in an S corporation, you're restricting how you can move it around. So for example, like if you have an S corporation where you do all your flips, and now you have a partner that is going to do one project with you, just one standalone project, and that's it. And now you have this property in your S corporation, and you want to quick claim it from your S corporation to your partnership with this person. That can create a tax for you. So that's where a lot of people are not really thinking about, am I using the optimal entity type for what I'm trying to accomplish?
Right. And considering future investments, because to give you guys an example of what he's saying is you can start with an S corp thinking, oh, I'm just going to be by myself flipping properties. And what ends up happening, as I'm sure any business owner who started doing small business understands and knows, is usually friends and family don't start working with you until they're like, oh, okay, Jane and John Smith, they look like they know what they're doing. They've been doing this for quite a while, and they look pretty successful. I kind of want some of the action. So that's when you get Uncle Tom or Uncle Bob who says, hey, I see you're doing pretty good with those investments and those flips. I have some money set aside, and I'd love to be your partner. I'll just give you the money. I'll be the money guy. And quite often that happens. And I always suggest, please embrace those relationships, because those are great opportunities to make great capital based off of very low what's the word, just debt. When,
Yeah.
like considering hard money, for instance, instead of paying those regular hard money fees and the 12% rate, if you're using Uncle Tom or Bob's money, he's not going to charge you 12%. He's looking to make some money too, so you guys will benefit that way. So you want to embrace those relationships, and you want to take into account the entity you're going to be working or using, so that this way it's a smooth transaction or a smooth process when you're there.
Yeah, and then to your point, right? The thing is, things change, right? So let's say you do all your flips in the S corporation, and one of the reasons why an S corporation has advantages for flips is because flip is inventory property, right? Is dealer property, and what that means is that it's subject to self-employment tax, whereas a rental property that is held for the production of income is an investment property which is subject to capital gains. Capital gains, lower tax rate. Inventory, self-employment tax, higher tax.
Yeah. Put that down, please.
So what I'm getting at here is, right, when you're doing your investing, you want to think about it up front. What am I going to do with this property? Am I going to just flip it, or do I like it? Am I going to want to keep it as a rental in the end? Because if you started with the S corp, then you either have to keep it in the S corp as a rental property, and that presents its challenges later on, or you can say, you know what, I'm going to put this property in LLC, I'm going to rehab it, rent it out, and it's going to stay in the disregarded LLC for its whole life until I want to sell it, or something else comes about. The other thing that I see a lot is someone, let's say, for example, someone's a real estate agent, and they open up an LLC for their real estate income, and then they're like, you know what, this opportunity for a flip came in, I'm going to put it in the same entity. I don't want to go create a new one because that's more paperwork, more money, more taxes, and
Right.
it sounds like it's a good idea, but it's not. And the reason why is if you basically have in the same entity your income, which is the commissions that you earn, and your flip, well, if for some reason that flip doesn't become profitable and you get foreclosed on, well, that anything in that entity can be used to collect to pay the debt. So in other words, the the real estate commissions that you're earning that are sitting inside that same entity becomes collateral to pay off the debt. And that's why you want to keep things clean and separate, because when you start commingling different things in one single entity, it can become very costly and complicated. So from there, so now when we talk about like coming up with the perfect scenario, right? So going back to like what you said earlier, I'm a real estate agent, I do flips, I have rental properties. What should I do, right? So normally what I tell people is this, like I said a little while ago, if you're gonna be doing flips, the S Corp gives you the best bang for your buck, because all your profits get shielded from self-employment tax to the extent that you take a reasonable compensation for the work that you're doing. So normally, right, you pay self-employment tax up to the Social Security limit, which goes up every year. And then you still pay the Medicare tax on all your wages. So for example, if you do a flip and you end up profiting, let's say $1 million, right? So you get capped at your Social Security wages, which I believe is around $132,800, I believe. I got to double check. But the whole million is subject to the Medicare tax, which is 2.8%, and in some cases it goes up to 3.8. So it can get very high. You know what I mean? Like so what you want to do is when you do the S corporation with a reasonable compensation, you're basically saying, I'm going to pay myself, let's say, the maximum Social Security wages so that the remaining profit doesn't have to pay all the additional Medicare tax. So that could be a way for you to save a little bit on taxes by using an S corp for your flips. Also, by using multiple entities, if you have, let's say, for example, 4, 5, 7 rental properties, if you have them all in the same entity, it's almost like the same thing as not even having them in an entity and having them all under your name. Because when you have them all together, you're basically, if something happens in one, they can use the other properties as collateral because they're all in the same entity. So normally, the reason why you see most people create an LLC for each rental property, yeah, it does cost you more money because you're paying the corporate minimum tax for each entity. But if something happens on one, it's not a domino effect that's going to take out all the other properties. Where if you have them all under your name or all in the same LLC, it's basically the risk that you're taking on. And granted, you can always mitigate risk with insurance, but insurance, doesn't cover foreclosures. So you also want to prepare yourself in a way that you're taking care of the risk that you can manage.
Okay, so if I can ask a question. So here's the $1 million question that I know you've already answered, but I know people are still going to ask this, is I have a decision to make. I have multiple investment properties that I'm holding on to and renting out. Should I have an entity for each, or should I just have one entity for those properties? Now, here are my pros and cons based off of the information and knowledge you just gave me. I can protect myself from being sued and having all my assets affected by having each asset supported by its own entity. But the con is it's a little more expensive to receive that protection, right?
Yeah, I think the way to answer the question is until you don't see it happen to you is more expensive. Once you lose two properties in one swipe,
right,
then you say that was pretty cheap.
Right.
So when you think about the cost benefit, you got to think about worst case scenario.
Mm-hmm.
If the worst thing was to happen, it's like health insurance and car insurance.
Right.
We pay it every month, but we're not getting into car accidents each month. And that's what the fees that go with an LLC basically is you protecting yourself in case the worst thing happens. You're able to walk away, with a minor scratch and not really, something more severe.
Now, let me ask you this. If we have if I'm a flipper and I have started an entity as an S Corp, now decide to let Uncle Bob in. At this point, should I start a brand new entity LLC?
No, you absolutely not. That's the benefit of having the S corporations, that you can bring on an investor. So all you basically have to determine is how much money is the uncle going to give you, and what percentage of the ownership are you going to give the uncle. You just want to make sure, though, that the uncle is an eligible owner of an S corporation, because if the uncle is not an eligible owner, then you're basically going to accidentally undo your S corporation. And in other words, you're going to be a C corporation. And then you're going to have an issue where at some point this is going to catch up to you, and you're going to have to redo all your taxes as a C corporation and then pay the tax that would have been owed at that point in time. So there's when you want to make sure you do your due diligence and determine, all right, are they eligible to come in? And then if they're not, do I really want this investment from my uncle for me to say, will I just go ahead and form a new business, or maybe do a different business just for the projects that you do with that uncle, whereas everything that this person is not involved in can stay in your S corporation.
Okay. Now, I also want to make sure we discuss. So let me know if I'm just going ahead of myself right now. I want to make sure we discuss the difference that we'd be paying in taxes if we didn't have an entity versus taxes you'd be saving having an entity in place.
Yep. Well, and where you mainly see that, however, is with the S corporation along the lines of the self-employment tax, right? In the additional Medicare tax. Whereas, like, for example, if you have a realtor who's or not even a realtor, like any person who's self-employed, right? Who's filing their taxes through a Schedule C, sole proprietor, no LLC, nothing. And that same person forms an LLC, but doesn't make it a corporation, they pay the same amount of tax. So an LLC disregarded and a sole proprietor pay the same exact tax, because all that goes through a Schedule C, same thing, right?
Right.
Where you get to see some benefits is if you go with the S corporation and the C corporation route, mainly because Like, let's say, for example, in a C corporation scenario, you can deduct your health insurance as an expense to get to your taxable income. Whereas when you file a Schedule C, you cannot deduct the medical insurance there. You put it on a different part of the tax return for adjustments to income. So that's an area where you see some savings. Depending on also how you structure your retirement contributions, right? If you have like employer matches, you're able to deduct those as business expenses, but the contributions that you make as an employee are going to go in different places depending on the entity type that you have. So that's kind of where you see the well, and I take that back. The contributions you make as an employee are not deductible in either scenario, anyways. It's just one reduces your income as a W-2, right? When you get your W-2, it's less taxable income. Whereas when you do it on the 1040, it gets you to the same result, but it's slightly different.
Okay.
But I mean, those are kind of things. And then lastly, with the wages, right? So if you have somebody, and granted, the key thing is the reasonable compensation. A lot of times people do an S corporation and they want to pay themselves $15,000, even though the entity is making $200,000. So you got to ask yourself, if this person was working for an unrelated third party, how much would you pay this person? Is that the prevailing wage for this type of work? And that's where you basically see the savings. If you're someone who has a corporation and you're making $150,000 a year and you're paying yourself $20,000 a year, that's just a big red flag to get audited. And then you're going to have to pay after the fact all the taxes that you were avoiding all those years.
And how do you calculate a good number to claim if you're making 100,000 for the year?
Yep. So the way you look at multiple factors. I mean, one of the factors is, does this person work by themselves or is there a team, right? So for example, like, are you a broker or an agent? That's like one factor that you look into. Another factor that you look into is you can do like salary studies. So for example, like salary.com, they'll tell you like in this zip code, this type of work gets paid this type of hours. I mean, this type per hour. You can also you can hire companies who do a study for you to tell you, very more precise, this is how much the prevailing salary for this person should be. And then you can also look at court cases. So there's always cases where reasonable compensation is getting challenged. So what you can do I'll give you a good example. Like there was a person in California that was going up against the IRS. I think he was paying himself $20 an hour. The IRS said, no, you should be paying yourself $80 an hour. And the court basically laid out their analysis. And they said, we think you should have paid yourself $40 an hour. So if your situation is very similar to that court case, then you can basically say, all right, I should be around that mark, right? Granted, if that court case was 10 years ago, you have to adjust the salary for inflation. But, it's just different. You want to have documented how you got to your number and not just like, pick a low number so that you don't pay a lot of taxes.
What comes down to, guys, is make sure you talk to a professional before you make a decision. You talk to your CPA, you talk to your attorney, and do all the homework first, because when it comes to entities, you want to make sure you're protected and it's working in your best interest, not working against you.
And I'll tell you something, a common myth with entities, and actually a really good example going back to realtors is you're always liable for your personal acts, right? So if you're a real estate agent and you are involved in a transaction and then that transaction gets litigated, your errors and omission insurance is what's going to save you. It's not going to be the fact that you're in an LLC or an S Corp or a C Corp, right? Because even if that entity gets sued and it files for bankruptcy, because it was your personal act, you were personally involved in that transaction, you're liable for it. So that's why it's good to combine the entity with insurance, right? If you're a broker and there's a transaction that you weren't really involved in, one of your agents was handling, and they didn't really consult with you or anything like that, that's where you have some other limited liability protection where you're saying, somebody in my office did it, but it wasn't me directly. So that shields you a little bit more from you being personally liable. So that's one of the big misconceptions that are out there, that people think, oh, just because I have an entity, I can do whatever I want and not be personally liable. Also, sometimes when you take out debts, they make you take a personal guarantee on the debt, even though you're doing it through your entity. So be on the lookout for that, right? Because anything that you personally guarantee, you're personally liable for, even though it's under the entity's name.
Oh, wow. That's interesting. Now, I do have a question. Is there an average or an idea of a number of how much you can save percentage-wise, or how much you expected to pay percentage-wise in taxes if I'm just a sole proprietor, like no entity at all, or someone with an entity? Like, what's that number look like? I mean, we know the news always says, oh, you're gonna pay 30% in taxes if you don't have an entity. But then you hear people like Amazon, like these big businesses that pay nothing in taxes. How's that happening? What are they doing? What's the big number there?
Yeah, I think part of, like, when you go to Amazon, part of the reason why they don't pay taxes in many instances is because, like, I want to say maybe like 2 years ago, they were doing a search, right? And there was a bunch of places competing to hold the next Amazon headquarters. Well, when they're putting their packages together, they're offering, like, all right, we'll give you 10 years, no property taxes. We're going to give you payroll tax credits. We're going to like, they put together these nice little packages to
The
make it.
state that they're moving to.
Yeah, to incentivize you to create all the jobs. Because basically what they're saying is, maybe we won't make money on the corporation, but all the people who are going to be working there making high salaries will offset it, So basically,
that makes sense.
If you're a small player, you can't expect you're going to get such a sweetheart deal. Something that you can do, however, is if you're going to open up a business and you start doing your projections, right? So let's say you're going to open up like a technology company and you expect to hire 10 employees in the next 3 years, right? You can go to the Commerce Corporation, at least in Rhode Island, and engage them and say, hey, I'm thinking about opening a business in Rhode Island and I'm going to hire 10 employees in 3 years. What can you offer me? And they would offer you payroll tax credits and things like that to incentivize you to do that. Now, once you open a business and you hire them, you can't go after the fact and say, hey, can I get a tax credit? That's kind of too late.
Right.
So what you want to do is do it beforehand. And that's kind of a way where smaller players are able to get some benefits like that.
So now let me give you an example. Let's say I'm a painter and I have my own painting business. I know someone in the chat probably just said, yes, finally. Because a particular friend of mine,
yeah.
He is a painter. He has his own painting business. But so I'm a painter and I'm contemplating opening an entity. And I don't know which one to go with, but I don't know what's the benefit. Aside from, I understand the legal shielding and protection I'm getting, what is the tax benefit versus, like, how much am I paying more in taxes if I don't have an entity, or if I do have an entity, am I saving? What's that look like?
Yeah, and I think there, right, I mean, there's a few things that you want to cover. For example, like, is it just this one person by themselves, or do they have like a team of painters who are working with them?
Just me right now.
If it's just you right now, then we also have to look to see, like, how much money are you making per year, right? Because there's some points where you, like, I usually tell people, if you're profiting less than $50,000, there's no even point about thinking about doing anything other than a single member LLC, because the cost of having payroll and the compliance work of filing the taxes and all that stuff is more than going to erode any possible savings that you can get from being incorporated. And that's something that's really important to highlight. What I usually say to people is, if you have a business that is growing, right, that is creating profits, but the profits need to go back into the business, that's where having something like a C corporation can be beneficial, right? Because let's say this person's a painter and they want to buy a building and then they want to expand and hire, 10 employees, and they want to buy trucks and all that stuff. Well, if you are a sole proprietor or a disregarded LLC, and even an S corp, all the income that you make gets taxed that year, right? And they might throw you into a higher tax bracket. Where with the C corporation, you have a flat 21% tax rate, and then only the money that you take out as a distribution would pay the dividend tax of 15%. So that allows you to keep money in the business, continue to grow it without having to be fully taxed on everything. Because what happens is, right, it's all about how you plan on using the capital. A C corporation that pays the 21% taxes plus distributes all the money in the form of dividends is paying 21% plus 15% capital gains rate, right? So that's 36%.
Yeah.
Well, the highest individual rate is 37%. So it's like you're not really generating that much money,
Right.
that much savings. So you have to think about it's not just how much money am I making. It's also is combining that with the strategy for the business. Is it a growth strategy? Is it just maintain strategy, or am I even thinking about selling the business or you know what I mean? So depending on what your strategy is when we talk about, all right, this entity type benefits you because of XYZ. So a lot of times people want the entity to fit the business, but you got to take the business to fit into the entity. And that's how you really take advantage of the corporations and the incorporated. I think a lot of times people want to fit the corporation into the business. And when you do that, you come across things that you weren't thinking about that become a problem. So for example, when you put rental properties in an S corporation, you're thinking about one tax saving, but you're creating a tax issue in another area. And that's really when you want to sit down and talk to someone and say, look, these are all the things that I want to do with this business. How do we go from here? Versus just trying to fit something into something that maybe doesn't fit into.
Definitely. That makes sense. Okay. Diego, I don't want to cut you short, man. Did you want to touch on anything else? I don't want to take too much of your time.
No, the last thing that I wanted to touch upon, which is usually something that people get caught off guard about, is when you incorporate, right? So now we're talking about your LLCs, your C Corps, and your S Corps. There's a cost to create the entity, right? Then you have to file an annual report every year. And the annual report is basically like, it lists, the entity, the address, the officers. So if someone wants to sue you, they know where to find you to serve you, right? So you have to keep your entity active with the Secretary of State every year by filing the annual report. And then you have to pay your corporate minimum tax, which in Rhode Island is $400 per year, regardless of whether you make a profit or not. And that's very important because a lot of times people say, well, I ain't making any money, so why should I pay this tax? That's just a tax for having an entity open in the state. So a lot of times, someone will open up an entity and they'll do it like in November, December, and they're not even planning on doing anything with it until like February or March. Opening up an entity is a pretty quick process. So I usually tell them, wait until you're absolutely ready when you're going to start doing business, that you're going to start doing business, and then go ahead and open it. Because once you create the entity, if 2 years go by and now you say, you know what, I don't want to do this anymore, I want to close this entity, you find yourself in a position where you have to get a letter of good standing from the Division of Taxation, which costs $50. You have to file 2 years of your corporate taxes and pay $400 per year. So now you have $800. And then you got to go to the Secretary of State and pay to dissolve the entity, which I think is like another $50. So that, whatever that you want to call that, costs you $900 plus the cost of having someone fill those forms out for you, unless you're going to do it yourself. So a lot of times, that's where I kind of see people get themselves in trouble, where they open entities, they don't use them, they don't pay their corporate taxes, and it becomes an issue. The other area where I see an issue is when someone's doing flips and they only have like one property or two properties in the LLC that they're flipping in. Because in Rhode Island, there's a law that if you're doing a major disposition of your assets, so if you're getting rid of 50% or more of the assets, you're required to get a letter of good standing from the Division of Taxation, which means you have to prepare a short year tax return, you know, a pro forma projection of how much you think you're going to gain. Submit all that to the Division of Taxation. They give you a letter of good standing. Now you can go close. Well, if you think about that, right, you're basically paying to get, even though it's not a full year, but you're paying to get your taxes done. And if you go ahead and you do 3 or 4 flips in a year, you're going to have to update those numbers 3 or 4 times. So think about that as well when you're going about determining how you want to structure your flips.
Right.
Because if you're going to be very unhappy and you're constantly paying someone, you know, a few $100s every time you want to sell a house. So it's something. And also, you're forced to pay the $400. It's usually due by the time the tax return is due the following year. But when you're doing the flip, if you're doing your flip in February of this year, instead of you waiting until April of next year, you're paying your $400 in February of this year, because that's what they like to do. They like to accelerate the payment. So that's basically it. So just know your corporate minimum taxes, know the benefits and the drawbacks of the type of entity that you're choosing, so that there's no surprises and you're not finding yourself saying, I didn't know that while you're writing a check.
Right. And guys, too, there's other things aside from paying your taxes and paying the state, is you got to make sure you have payroll set up and you're paying yourself. There's other steps. So make sure you can reach out to even me or Diego or any of your own CPAs that you work with or attorneys you work with. Diego, I have a couple people asking for you to share your contact information. Please be sure to log into Facebook, jump on that page where they're asking to share your info there. But also, please share your info now, just online while we're still live.
Yep, so you can reach me at 401-489-9567, 401-489-9567, and by email at Diego, Diego, at Lurad, LURODTAX.com. I'll put that in the comments as well in the video.
What is your Facebook page? What's that called?
Lurad Financial Group, LLC. So if you go there, you can find me there as well and hit a like.
Awesome. How do you spell that? I have a hard time.
LUROD.
LUROD?
Yep, Financial Group.
Awesome. Guys, so I'm going to give a quick glance over this, make sure I didn't miss any questions, because we're going to let Diego go here soon. You guys know who I am, Josh DeBrossard, the Firefighting Realtor. Over at Century 21 now, the Sable team. My contact information, 401-347-7410. You guys can look for me anywhere from YouTube as Josh DeBrossard, the Firefighting Realtor. My Facebook business page is Josh DeBrossard, the Firefighting Realtor. Joshua DeBrossard is my personal account, if you want to look up my personal page. And what's a good one? Oh, of course, the group page, the one that we're streaming live on, Financial Chaos to Financial Freedom, is our Facebook page that we have. Again, we do it for you guys. So if you guys have ideas as to what you want to see on here, other webinars, other topics you want to discuss, please, because I'm thinking about probably doing like maybe a buyer seminar, a seller seminar next, touch on insurance. But if you guys want to do something as far as a little more educational for, anything, name it, just sky's the limit. Because again, I want us to work together here as a community and educate each other. The name of the game is to literally get ourselves from the financial chaos we're in and out of it. And if you're out of it now, please help your peers, So, and also, like I always like to say, remember, never forget and keep that millionaire mindset. All right. Thanks, Diego. Bye, guys.
Take care.